Now let's bring in Lauren Goodwin of New York Life Investments and Brian Levitt of Invesco. It's great to have you both here as well. Lauren, you get the first shot at this market today. We know the tariffs coming. I mean, at least we think, because it's been telegraphed that we're going to get 25% tariffs on steel and aluminum, and yet the market looks pretty good today. What does that say?
Well, the market is reacting to tariffs in a context of an economic and earnings backdrop that's been really strong. Gives a lot of resilience to some of the headline inflation and other news that we've been getting. I think, though, that one of the reasons why the market has been so incredibly well behaved is because of the December inflation print we got in January. It's helped keep the 10-year yield relatively well balanced. It's helped to sort of create a ballast against some of these outside pressures that we're seeing. Now that we have tariffs coming in, there's been a lot of conversation about what does this then mean for the near-term inflation outlook, and I think that's a really valid question. A couple of things I'd raise for investors is, first of all, regardless of whether tariffs make a short-term or medium-term inflation outlook, this is the beginning of or rather one step on a long train of trends towards a more sort of inflation-prone global economy. And so as investors, I think we have to think not only about the risks like an inflation print we'll see on Wednesday, but also a portfolio that needs to accommodate this geopolitical and political risk more regularly.
Earnings are greater than tariffs. Is that to take away?
Yeah, I think earnings are greater than tariffs. I mean, the reality with tariffs is we've wanted clarity. The market wants clarity. We don't want a prolonged period of policy uncertainty.
I mean, even if we know they're coming.
We know they're coming.
Just put them on the table already,
Just
right?
put them on yeah, I mean, I think there was a lot of concern with Canada and Mexico a week or so ago, and then it proved to be just a negotiating point for the administration. So I think the markets have kind of viewed this as we're going to put these things out there and they're going to become negotiated. I think if we go through a prolonged period of ever-increasing tariffs or broader tariffs, like we saw in 2018, that could start to hit sentiment. But as of now, yeah, earnings trump.
But I mean, there is
tariffs.
A suggestion that certainly as it relates to these specific tariffs,
yeah,
steel and aluminum, that they're more structural in nature. It's not necessarily a bargaining chip. It's like, we're tired of the U.S. getting, in the words that they've used, ripped off. We're tired of steel dumping, and et cetera. And that this is more of a structural item, not like, okay, I'm just going to throw this out there for 10 minutes and then I'm going to take it back and everything's going to be great.
Yeah. I mean, structural goes back to the idea of clarity, though. The idea that, these may not be the same as what we saw with Canada and Mexico initially on the initial 25% tariffs. But yeah, this is the news, right? The whole idea of just tell us what the rules of the game are, and we'll adjust accordingly with regards to the market.
How do you feel about the market overall? Are we in a pretty good spot? I mean, we're, two-thirds through earnings season. We've had some broadening. I mean, I think there's a fair question about what tech is going to do from here. You heard Steph. I mean, she's a big believer and a big bettor on the fact that we're going to have this good broadening, and we're not going to really need the mega caps to drive the train. It doesn't have to be the locomotive anymore.
One of the things that I took away from the conversation around tech from Steph and Jean was that there's a lot of yes and going on. Yes, the fundamental story for tech stocks, which is a big part of market performance over the last couple of years, is a robust one. There is demand for what these companies are putting forward, and it's unlikely that that demand collapses in the next couple of quarters. It is also true that the risks to the valuations that we see are starting to increase. We're seeing more jitters related to China, related to competition, related to tariffs, even just related to market health with respect to inflation, where rates are, et cetera. And so this is a market where I feel, because the U.S. economy is strong, has legs. I'm optimistic. We're fully invested. But we are starting to broaden not only into different parts of the tech and AI trade, but also, again, to some of these more inflation-aware asset classes, because that is, from my perspective, one of the biggest risks that could impact not just market levels, but market positioning.